Have you ever felt like investing is a game you just can't seem to win? No matter how hard you try, you never seem to make the right moves or earn the returns you hope for. Well, maybe you're making some of these investing mistakes, which Warren Buffett sees amateur investors make. Buffett built his empire by avoiding these mistakes and focusing on fundamentals. With a net worth of over $100 billion, it's safe to say the man knows his trade when it comes to investing. Welcome to MoneyWise Investor, your trusted source for financial information. In this video, we'll explore the 12 biggest mistakes every investor makes, so you can sidestep these pitfalls and invest like a pro. But before we dive in, be sure to subscribe to our channel so you never miss out on any of our uploads, and click that notification bell to stay on top of it all. Alright, let's get into Warren Buffett's 12 fatal investor mistakes and how you can avoid them. Mistake number 1. Overtrading. As Warren Buffett advises, our favorite holding period is forever. When you sell a winner, those shares can no longer grow. Buffett selects companies he believes in for the long haul. By holding them for years, even decades, he gives his picks time to realize their full potential. Buffett once said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Many overtrade because they are trying to time the market or chase momentary trends. But market timing is exceptionally difficult, even for experts. Buffett does not pretend to know which way prices will move next week or next month. Instead, he focuses on a company's long-term fundamentals. He buys quality stocks with strong competitive advantages and holds them through ups and downs. Rather than watch CNBC all day and react to news, adopt Buffett's patient mindset. You'll avoid costly overtrading mistakes and achieve better returns. Mistake number 2. Failing to properly research. Many investors do not conduct thorough research before buying a stock, but failing to research is a critical mistake. Warren Buffett and his partner Charlie Munger employ an extremely rigorous vetting process before investing a single dollar. As Munger stated, "We don't just buy at a statistically cheap price and hope. We do enough research so when we buy something, we're pretty sure we're right." Before committing capital, Buffett wants full insight into a business. He studies annual reports going back decades. He analyzes financial metrics like revenue, margins, debt levels, and cash flows over long time frames. This paints a picture of how a company has navigated various economic environments. Adopt Buffett's diligent process. Rather than hastily jump into investments, take the time needed to study financials and build informed opinions. Patiently learn everything about a company, from products to competitors. Research until you have confidence in your analysis. With the proper homework, you can invest wisely. Mistake number 3. Following the crowd. Another mistake is following the herd mentality and chasing trends. Many novice investors let emotions or hype sway their decisions. When a stock is rising, the fear of missing out, or FOMO, kicks in. People rush to buy simply because everyone else is. But Buffett resists such urges, remaining rational when others get emotional. He thinks independently and makes contrarian plays. Buffett urges investors to break free of the herd mentality. Rather than blindly follow the crowd, evaluate each opportunity on its own merits. Be greedy when others are fearful, and fearful when others get greedy. Let logic, not emotion, drive your decisions. Ignore trends and popular narratives. With inner discipline, you can avoid main mistakes and make smart contrarian bets like Buffett. Mistake number 4. Failing to control emotions. According to Buffett, once you have ordinary intelligence, what you need is the temperament to control the urges that get other people in trouble in investing. He remains calm in chaotic times and doesn't get caught up in hype. He focuses solely on business fundamentals, not emotions. Even at his current age of 92, Buffett evaluates opportunities with a cool head. Letting emotions drive decisions is an investing pitfall. Under volatile, stressful market conditions, fear and greed tend to take over. When prices plunge, investors panic and impulsively sell quality assets. When euphoria strikes in bull markets, greed causes people to chase unsustainable gains. Buffett avoids such emotional pitfalls. Maintain equanimity and think rationally in all environments. Make your investing mantra fundamentals over feelings. Master your emotions like Buffett and avoid irrational moves. Mistake number 5. Failing to diversify. In his 2014 letter to Berkshire Hathaway shareholders, Buffett wrote, For most people, a widely diversified portfolio of stocks and bonds best meets this test. While you may have strong conviction in a particular stock, anything can happen. Unforeseeable events can derail otherwise promising companies. No matter how promising the opportunity, maintaining a diversified portfolio across sectors, industries, market caps, investment styles, and geographic regions reduces risk. Don't put all of your eggs in just one or two baskets. Spread holdings out intelligently. Mistake number 6. Ignoring company fundamentals. Far too many investors select stocks without considering underlying company and industry fundamentals. But for Buffett, everything starts with the strength of the business itself. He does not invest in hype or technical patterns on a chart. He seeks companies with durable competitive advantages, strong financials, quality management, and multi-decade runways for expansion. In Buffett's view, it's far better to buy a wonderful company at a fair price than buy a fair company at a wonderful price. He ranks the quality of the business and the on-ground operations as paramount. Don't put the cart before the horse. Before you even consider stock price or technical indicators, evaluate the underlying business. Take a page from Buffett's book and fully examine financials, management, competition, industry dynamics, and growth prospects. Choose wonderful businesses first, then look for attractive prices to buy. Focusing on fundamentals is key. Mistake number 7. Trying to time the market. Numerous investors try to time the market, jumping in and out of stocks, attempting to capitalize on short-term swings. But Buffett strongly cautions against this. He once stated, "We continue to make more money when snoring than when active." Rather than trade in and out, Buffett prefers to buy quality companies and hold them for the long run. Patience and discipline are better strategies according to Buffett. He waits patiently for buying opportunities when market turmoil drives prices lower. But once invested, Buffett holds steady, letting long-term trends drive growth. Avoid the fruitless pursuit of market timing. Pick strong stocks. Buy at advantageous prices, then allow time and compounding to work their magic. Mistake number 8. Paying high fees and costs. Buffett abhors waste in any form, including excessive fees and costs. He seeks maximum returns, so he avoids funds with inflated expense ratios, loads, commissions, and transaction costs. These expenses directly eat into investor gains. As Buffett says, when trillions of dollars are managed by Wall Streeters, charging high fees, it will usually be the managers who reap the outsized profits, not the clients. Avoid load funds with upfront fees and funds with expense ratios over 1%. Seek low turnover ETFs and index funds whenever suitable. Minimize transaction volume to reduce trading costs. Following the Oracle's low-fee approach will elevate long-term returns. Mistake number 9. Ignoring income investing. Unlike many on Wall Street, Buffett does not view income investing as old-fashioned or boring. He appreciates the steady, patient nature of dividend stocks and bonds. Income securities provide stability, while also delivering healthy long-term returns. Income investing aligns nicely with Buffett's patient approach. The cash flow cushion provided by dividends helps weather volatile markets. Income stocks benefit from long holding periods, as regular payout increases drive compound growth. Don't ignore this important component. Include quality dividend payers and bond ladders to generate steady cash flow alongside overall portfolio growth. Mistake number 10. Chasing quick riches. Many investors are seduced by the prospect of fast profits from hot tips, speculative bets, and momentum trading. But these are not roads to enduring wealth. Buffett steers clear of get-rich-quick schemes, warning that what the wise do in the beginning, fools do in the end. He focuses not on rapid trades, but quality companies. Avoid temptation and take the patient path. Build wealth slowly by buying pieces of excellent businesses at fair prices. Hold them long enough for compound growth to work its magic. Constantly apply this diligent process over decades. Get-rich-quick investing is futile, but this value-focused approach can make you very wealthy over time. Mistake number 11. Failing to adapt your strategy. Buffett understands that investing dynamics continually evolve. The wisdom that proves profitable one decade may become obsolete the next. Failing to adapt is a critical mistake. Buffett does not rigidly stick to the same playbook. he updates strategies to suit changing times. In his early career, Buffett made money buying cigar butts, beaten down companies trading below liquidation value. But as markets matured, this approach became less effective. Buffett gradually shifted to buying high-quality growth companies at fair prices, companies like Coca-Cola and Apple. Do not cling stubbornly to one approach out of habit or ego. Objectively assess what is working under current market conditions and what requires tweaking. Adapt your strategies, just as Buffett has done to remain successful over many decades. Mistake number 12. Failing to continue learning. Buffett spends 80% of his workday reading, building his financial literacy even at 92. He consumes books, annual reports, SEC filings, newspapers, anything to deepen his understanding. As he says, "I'm not in the business of predicting markets. I'm in the business of trying to understand what's going on in the world." Even with his vast experience, Buffett maintains a humble student mindset. He recognizes there is always more progress to be made. Complacency and arrogance are toxic in investing. Markets are far too dynamic. New technologies and unforeseen events arise constantly. If you are not diligently expanding your knowledge, adapting becomes impossible. Continuously add tools to your mental toolkit. Maintain an eager, open mind at every stage. With this attitude of radical transparency and hunger to improve, your investing skills will only grow stronger with time. Don't let avoidable errors sabotage your returns. You have the capacity to be an outstanding investor in your own right. Learn from the timeless lessons of the Oracle himself. Let Buffett's principles guide you towards building generational wealth. If adopted in earnest, these strategies can help you achieve the financial freedom you desire. And of course, if you found this video helpful, be sure to like and subscribe for more insider investing knowledge. Thanks for joining us today. Until next time, stay money-wise.